Hi, we are live from New York because I want to thank John for having taught me pretty much everything I know about finance. Now, not many firms survive 30 years, and the fact that Edgerton has gone through 30 years of uninterrupted success is just a huge achievement. Now, I managed 15 years in my company. John has done twice that amount. I don't think anybody understands what it takes in terms of day in, day out hard work, all the stress you sit through. It's a huge achievement. A big congratulations, John. You are really AAA.
Well, that was Nikolai Tangen, who is now the CEO of Norges Bank Investment Management, the largest single equities investor in the world. And Nikolai, before Norges, ran AKO Capital, but his first job on the buy side was working for John Armitage, my guest in the podcast in this video. Before getting to that interview with John, I've also interviewed Paul Tucker, who used to work with John, I think, for 15 years, and he talks about what John is like to work with. That's a great lead-in to the actual interview itself. And let me just tell you a bit about John Armitage, because he's a giant, not only in the hedge fund world, but in the world of investing more broadly. He has been one of the best investors in the world. He has produced a long-only record of about 7% after fees, better than the index, with an average cash balance of 12%. That's quite extraordinary. And when you combine his strategy at Edgerton over 30 years with his previous fund at Morgan Grenfell, he's actually delivered a return of 350 times your money. So you'd invested $10,000 with him in 1988, you'd have 3.5 million today. Quite extraordinary. The index has gone up 41 times over that period. So he's done astonishingly well. And in this conversation, John explains how he started with just $10 million and why you couldn't do that today. He talks about it, his portfolio. He talks about his approach to investing. He explains why he requires his analysts to follow more than one sector, which is very unusual, and why he doesn't employ data scientists. He also reveals that he thinks his performance would suffer if he had permanent capital. He doesn't say it explicitly, but it's clear that the performance matters more to him than the wealth that he would personally accrue. John is a brilliant investor and one of the best people at summarizing a stock that I have ever met. He's also someone who focuses on company financials, which is an underrated skill these days. I felt privileged to sit down with him for an hour, and I learned a lot. And it's funny, really, because he doesn't actually tell you exactly how he does it. It's almost like it's natural to him. And he came out with some gems, like you just have to focus on what's important. And although that's blindingly obvious in a way, thinking about our conversation on the way back from his office, as I walked back to my office, I realized I could gain a lot more time if I followed that advice. I think this is a really super conversation. I hope you enjoy it. Paul Tucker, you worked for John Armitage. What's he like?
Well, look, Steve, great to be here and straight to the point. So I mean, just to level set, I worked with John as a partner in his firm for about 15 years, and we sort of had a front row seat of various times. You know, the firm was relatively successful in that time. We sort of lived through the financial crisis and sort of went to war together. I mean, I guess I'd say a few things. And the first thing I'm often reminded of a quote that I think John even himself gave about himself when asked about how he saw himself, and he'd sort of likened himself to a prospector for gold, sort of agonizingly bent over in a stream, you know, panning away for days and weeks on end with absolutely nothing going on. And then eventually, once in a while, you sort of stumble across a flake, and very once in a while, you know, you get a nugget. And that says a lot about John and, you know, his process in many ways, because people would ask me, our investors would say, well, what's the sort of secret sauce? What is the kind of algorithm, you know, the whole kind of process that Edgerton and John uses? And I'd always say he's much more of an artist than a scientist, right? He doesn't have a secret sauce in a way other than doing enormous amounts of very, very intensive hard work and really just seeing investing about something that's about getting to the truth, knowing more information than anybody else, not leaving any stone unturned, no river unpanned, and eventually kind of arriving at a superior understanding of a company compared to the very many smart people who are in this business doing pretty much exactly the same as we were. And that in a nutshell is the way that he works. He's about truth, nothing unturned, reading every filing, doing every meeting, asking every question. And eventually that tends to lead to superior outcomes. I mean, in terms of, what is he like? Look, it was an incredible privilege for me to work with John for 15 years. And I went in there having spent a lot of time at other firms, both on the buy side and the sell side. So you kind of think, well, how much can I really learn here? But he has an unbelievable ability to get to the point with any particular investment. And it was almost agonizingly frustrating in a way, because you can see, John he'll have an idea or I'll have an idea and we'll sort of go away and do our work on it. And you know what this is like, Steve. You've done it yourself. You're in a rush. You want to get up to speed. You want to know everything there is to know about, company X, equity Y, bond Z. And you read the filings and you read the transcripts and you maybe have a call with a company and you look at the models and you think you've done all this work for days or weeks on end. And of course, you sit down with John and he'd have this incredibly annoying ability to get absolutely to the point with the most disarmingly simple question that you have completely failed to ask. And he's very, very good at that. Sometimes, you think you've done the work. We've sort of been here and done it before. But John would sort of distill any situation down into what really matters. And it could be the most simple question. And often, you'd be in a company meeting with him and he'd ask the question and people would be sort of looking at themselves and they'd say, well, gosh, nobody's ever asked us that before. But it'll be the most obvious thing that gets entirely to the point. So he's brilliant at those things. He is very artistic, not very formulaic, but he has a real knack of getting to the point.
And what gives you that ability to zero in on the crucial issue? Is it just brilliance? Is it experience, a combination of experience and brilliance?
So I think it's I think he's undoubtedly brilliant. He's very, very clever. He's incredibly interested in companies, in business, in the way things work. And so once he's sort of got the bit between his teeth, he just wants to know more than anybody else in the world knows. So he's got this endless curiosity. And I think he's got a sort of inherent understanding of, what makes a business tick, right? Cutting through the nonsense and really sort of understanding what makes a business tick. And he's just very, very good at that. And so, instead of sort of formulaically going through a checklist because he's been told at business school, we've got to look at margins and return on capital and leverage and sort of tick, 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 tick. Actually, he's very good at understanding the nuances of a particular situation and then getting absolutely to the point. And I think the other thing, in terms of his process and his approach to things, and I learned an awful lot from John in this way. We've all been in meetings where there are a bunch of so-called smart people in the room, and you've kind of had an answer to a question. It doesn't really make sense, or you haven't really understood it, or there's a deceptively simple question that you want to ask, but nobody's asking it. And you don't want to look like an idiot because you assume everybody else knows the answer. So why would you ask that question? Or everybody's understood what the CFO has said. And John's completely unafraid to ask the same question. He's a bit like Jeremy Paxman in that sort of famous interview on Newsnight all those years ago, where he's completely unafraid and unembarrassed to ask the same question time after time after time until he gets the answer. And not in an impolite way, but just in a way that will be disarming. And he'll typically present it as, well, look, I'm awfully sorry. I know I'm probably being really dim here, but I didn't understand what you said. And of course, it gets right to the point that actually, if a company can't explain what it's doing, then maybe they don't want you to understand. Maybe they're hiding something, and we've seen that. So he's very good at those things. I think the other thing for me, he has got. Again, when you think about what makes him tick, and I always said this to investors, if I absolutely believe, some people in this industry, and John's been doing this for 30 odd years, some people in this industry you make money, you start cutting corners, you think you've got it all figured out, you've developed a process and an understanding. And John has this, what I used to call constructive paranoia, where, he was never that person. He never wanted to cut corners. He was always, worried about what was he missing? What did he not understand? And he's the guy, look, he's been successful in his business. He's been financially successful. But, I always believed, in fact, I pretty much know that, he would trade any sort of amount of financial compensation for a few basis points on his long-term compound annual growth rate of performance, because he's ultra competitive and he cares about his promises to his clients. And that was the thing that mattered most to him. And he never ever fell into the trap of, what one of my other partners used to call affluenza. He'd love these sort of, these statements which would combine some kind of illness with some kind of, failure in business. And John never fell into that trap. He made some money. He was successful. Everybody knows who John Armitage is, but he just gets up every day and does the work.
That's brilliant. Paul Tucker, thank you very much.
Thank you.
Well, John, you were my first podcast guest along with Brent Hoberman. I'm delighted that you're now the first returning guest. And the reason, not that we need an excuse, is the impending 30th anniversary of Edgerton Capital, which started 30 years ago and first started investing money when this podcast will be published. So look, hedge funds, fairly young phenomenon. Not many have lasted 30 years, and not many long-only funds have lasted 30 years. I doubt when you started out, you would imagine that you would be looking back like this. But if you were doing this today, would you do this any differently? Or what advice would you give to someone who was setting out on the journey that you set out on 30 years ago?
First of all, of course, there's no way I could have possibly imagined that my career would turn out as I have been lucky enough to have it turned out. And secondly, it's not a question of what I would want to do, but what I would have to do. Because when we started, you needed much less dollars to have critical mass. We were thrilled when we got to $150 million under management.
How long did that take?
After about a year, we were absolutely thrilled. And on day one, when we opened our business, I think we had $10 million under management. And we started with, I think there were 3 other people in the firm. And now you need much more infrastructure. And the markets are much harder for different reasons. So I would have to do it a bit differently. And luckily, I don't have to think about that's not a decision I have to take, but I would have to do it a bit differently, and it would be a lot more difficult.
Investing a lot more difficult than it was back then, because there's been all sorts of structural changes in markets. What's most difficult? You've got lots of different drivers, haven't you? You've got growth of passive, all the algorithmic trading, you've got all the pod shops. How are these things affecting markets, and how do they affect the way you manage the portfolio?
Well, the markets are a lot more difficult, and I think there are style-based reasons and then more profound reasons why they're more difficult. And the most profound reason why stock markets are more difficult to outperform in is that if you take any industry which is very profitable and has very low barriers to entry by the standards of manufacturing or banking or business services, that's going to attract, and as I say, has the potential to yield great profits. Clearly, it's going to attract a mass of talent. And the capital employed of the investment management industry is, in fact, people. And we've been through a period where all the most talented, where many talented people went into investment management. And the more time you have talent, the more talent competes for an edge, the harder it is to have that edge. It's just as simple as that. Look, local language models, LLMs, are now becoming a commodity. What is the edge in each LLM? When there's only one LLM or only 2 LLMs or only 3 LLMs, they have an edge. But when there are lots of them, that edge is harder to define. So for the very simple reason that the investment management industry has attracted a ton of talent, it's harder. It has to be harder.
Sure.
If it weren't, something would be wrong about the way industries work. I think all the stuff about pods and passives, that's more relevant in sort of particular phases in the market. What is different from when I was young is that when I think about it, every year I've been investing in years where we've done really badly and in years where we've done really well. There's always been companies whose shares have done much better than us. And I'm sure every year I've been investing, there's been a stock which has been up 100% or 150% or 200%. But it didn't really, and it would have been nice to have caught all those. But actually, what counted was what you bought yourself. We're now in a different era, which is reinforced by the rise of passive investing, where you have these very large, very profitable, very dominant companies with tremendous scale and tremendous barriers to entry, where the market is sort of structurally underweight them. Most investors are underweight them. And they begin to have a powerful impact on the overall index. If NVIDIA was a small company, it would have had no impact on our performance this year. But as it is, not owning NVIDIA cost us, I should think, 350 or 400 basis points of relative performance. And this is new in the last 30 years. So this slightly reminds me of investing in Japan in the late, of the Japanese market in the late 1980s. And luckily I never did that. But the Japanese banks went through the roof. They were a major component of the index. They were very, very, very expensive. And they caused tremendous underperformance by people who'd invested very successfully in Japan. And of course, afterwards, it was a massive bubble which unwound. And I'm not suggesting NVIDIA is not a bubble. It's an incredibly strong company, which has done very well. But the fact is that the performance of active managers is now affected by what they don't own in a way in which it never used to be. By single shares which they don't own in a way in which it never used to be.
And what's the solution to that? I mean, you just got to own them.
Get them right, I suppose.
But that's incredibly difficult when you've got such heavy weightings in the index.
Well, it's difficult if you don't get them right, but let's not feel too sorry for ourselves. We're paid to try and get things right.
No, absolutely. But even if you owned NVIDIA, would you own it to the degree that it's represented in the index?
Yes, you would. But when a large company goes up 150%, if you don't own it, it causes you to.
Of course,
it's a massive performance drag.
And what do you do in that sort of situation? I mean, you sit down and think, "Oh my goodness, I need to own it," or do you think a lot, maybe?
Well, very
a lot
sadly,
of people must do that.
Very sadly, what I haven't done is owned it. But I think what you have to do is try to be true to yourself and avoid being pushed around, because my own experience has been that when I've been pushed around and done something which I was reluctant to do, more times than not, it's been the wrong thing to have done.
Yeah. No, so you stick to your process.
I think you have to be true to yourself.
Absolutely.
To thine own self be true.
And how many positions would you normally have?
Well, at the moment we have about 35 to 40 long positions.
And what would you have a big weighting in the top position?
We're more concentrated than we used to be, and I vary a lot about thinking about concentration. On the one hand, I think that if you concentrate a lot and watch what you're concentrated in like a hawk, that is a good thing to do. And our biggest stocks tend to produce our best returns. On the other hand, if you run assets of more of a certain size, you do take a liquidity risk if you run a very concentrated portfolio. And secondly, the risk, the good thing about owning good companies for a long period of time is that they compound incredibly effectively in your favour. And gosh, I guess it's a very nice way to live. The bad thing is that they can change subtly. You don't notice it. And then one day you realize you've underperformed for a year, and gosh, you're just beginning to know why. And the analogy I use, we all know if we're unlucky enough to be up in the night when it's getting light, we all know that there's a moment in the night when it's perpetually dark. Then it's slowly a bit lighter, and it's slowly a bit lighter, and suddenly it's daytime. That's like realizing why what you've owned for a long time has been a massive underperformer. And that can happen. That kind of familiarity is a danger, which goes with concentration. Excessive familiarity and then complacency is a danger, which goes with concentration. And very few people are good at being sufficiently detached or remarking themselves intellectually every day.
But how do they do that? Because you're friends with
difficult.
Chris Hone, and he does that.
Well, he's a genius. He's a genius, but but Warren Buffett says he never sells stocks. But actually, it hasn't been a particularly good experience to have had a large position in Coca-Cola over the last 25 years. Absolutely. And that's the danger.
How do you mark yourself every day?
With difficulty, because it is difficult. Because human. I generally believe that human beings, in all kinds of ways, patterns are important in human beings. Patterns are important in relationships. Patterns are important. Different relationships have different patterns. And patterns are important in the way you think. And the difficulty with knowing a position really well is you just get too comfortable with it.
And is it because you get...
And so I like to have more positions so I can see... The analogy I like to use is you can plant a seed so that see if it germinates. Because maybe that's going to be really attractive. I mean, we've been lucky enough to have had some quite big holdings in reinsurance stocks over the last year, and that's a sector I really, really like. But actually, they started off with one small position in Munich Re, and then we did a lot of work on other things. So I kind of believe that, I couldn't run a permanent 10-stock portfolio. It just wouldn't work for me. It works for Chris because he's a genius, but it wouldn't work for me.
But how do you think he manages that process? Well, how does he get out?
Well, I think you ought to ask him. He's got a tremendously robust, intelligent mind.
This thing about getting too close to the companies, I mean, how do you keep the distance?
It's not too close to the companies. It's being insufficiently detached to see when things are changing and why, and to understand how they might go on to change. It's complacency. It's not about closeness. It's complacency.
And that's
intellectual complacency. Intellectual complacency. That can happen. That's a trap.
What would be the trigger then that would make you sell one of these stocks that you'd owned for a while and liked? I mean,
well, the best reason to sell, well, first of all, there's an easy reason to sell something, and that's when it disappoints.
Yeah.
The next best reason, and another good reason to sell something, is when you can find something better. And then you can sell things when the price is too high. But of course, it's easy to make mistakes about prices. Mm. And good companies tend to get better over time. And, we first bought Microsoft when it was on 10 times earnings. We didn't sadly own it throughout that period. And I wouldn't have guessed it would have ever traded at 35 times earnings. But it did because things changed. And so you have to be aware of what can happen.
Is it very difficult, do you find, to go back to something that you've sold? Or are you quite flexible?
I find it more difficult to go into things which have gone parabolic than go into what I've sold.
If you sold something and things have changed, and are you able to buy it back higher up?
Yeah, I don't mind doing that. Look, nearly every company you're ever going to buy has gone up a lot.
No, of course. You've
got to accept that.
And what's the longest you've owned something for? I mean,
I honestly couldn't say. I'm terribly sorry. I wouldn't know.
You wouldn't know?
A few years. I don't know, 5 years. I couldn't really tell you.
You've managed not to fall in love with stocks. That's the key message.
I don't always manage it, but I think one has to guard against. And I generally believe, look, I'm very lucky with my wife. I think it's a good thing being in love. But it's a good thing being in love with the right person or the right stock.
Yeah.
And the trouble is people's judgment. I like to think my judgment with regard to my wife has been infallible because she's marvellous. But my judgment with regard to stocks is not always infallible.
Yeah.
Therefore, it's a big mistake. Therefore, it can be a big mistake to fall in love
Yeah, absolutely.
with a stock.
But you're quite flexible, aren't you? You're.
I mean, I'm more flexible than I could be, and I'm less flexible than I should be.
Interesting. So when we first recorded, it was about 3 years ago, we were near the peak of the tech bubble, and SPACs were in vogue. Loss-making tech stocks were trading over 10 times sales and were commonplace. And you said, I can't understand these valuations. You said SPACs were in a bubble, and you were absolutely right. We also talked about Tesla, if you remember, and Tesla at the time, you were talking about there's going to be more competition in EVs. You said that autonomous was a long way off. Everything you said has come true, and Tesla's still about the same price, which we agreed was extremely high.
Well, it is down over 3 years, and earnings forecasts have gone down. And the thing about Tesla is, look, what have you got? It's a very retail-owned very retail-owned company. The retail investors love Elon Musk. He's a tremendously aggressive bloke. He's someone who is clearly a compelling genius, and he clearly talks a story. And he first talked the story about autonomous driving, I think it was in 2016, 2017. And the story now is that Tesla's going to become an AI company, and it's going to become a robots company. And I'm hearing that the story that he's telling is that, look, his cars and the neural network involved in their compute power and the GPUs that he's been buying from NVIDIA, that they are filming humans on the sidewalk and they're learning all about human behavior, and that's going to have tremendous implications for his robotics business. That's what I heard this morning from an analyst. But he is a guy who is a genius and a massive change agent, and he gets belief. And I think that's what it boils down to.
But
and now the story is the bulls on Tesla argue that the car business actually isn't that valuable for the company. And it's all going to be about the AV fleet, and the AV fleet stroke robotaxis, robots, AI. Cathy Wood's. I mean, I think I can't remember what US GDP is, but I'm pretty certain that Cathy Wood's latest valuation of Tesla was in 2030. Maybe I'm wrong. Was it 25% of US GDP or something like that?
Yeah, it's pretty
Why
close.
is that? Because she's a believer that AI will do something for them. And if you read Tesla's AGM stuff, you will see what Elon Musk says about the robots business. And look, there's no arguing with that. You either believe it or you don't. And within that share price, there's a big component of belief about what Tesla will mutate into, away from cars.
No, of course. But Cathy Wood, I've written about her research in the past, which, it's laughable. But she's managed to convince all these retail investors. What I'm curious about is we've had...
Cathy Wood thinks that in 2029, Tesla will be worth $8 trillion. So US GDP in 2022 was 25 trillion. I mean, I just don't believe it'll be worth 25%. Anyway.
But why do you think that is it just retail? I mean, I'd expected that we've had a big hike in interest rates and that a dose of reality would be injected in the system. But it hasn't deflated GameStop, hasn't deflated Bitcoin, it hasn't deflated Cathy Wood.
I mean, the ARC shares are down a lot.
Yeah. But she's still shouting from the rooftops. And I don't know...
Well, that's what believers do. That's what believers do.
Yeah. More generally, I mean, the GameStop phenomenon, Bitcoin, they're all manifestations of a zero interest rate environment. And I would have expected reality to have, hit them like, a car running into a brick wall. But it seems to be taking quite a long time.
Well, life is a funny thing.
Is it just that we underestimate the time lags in systems? I remember, when I started in the market...
I think these things change gradually. But But look, if you look in the last year, the S&P, which is generally composed of sort of better companies and less speculative companies, has, in the last year, 2 years, has massively outperformed the Russell. Low quality stocks have underperformed high quality stocks. So I think it is happening. But should it have happened quicker? Well, you or I would think so.
Yeah. So AI, we touched on it earlier, and it's sort of the topic of du jour, or topic of the year. I went to the WPP Investor Day, and I was sitting next to a pal of mine who's got, senior fund manager, quite a big fund. And within 15 seconds, the CEO had mentioned AI, and we laughed, and we turned around to each other and we laughed. But actually, later on, the executive of one of the agencies was saying that they'd guaranteed a 25% improvement in conversion on product pages. And I was really surprised. None of the analysts asked about this. Afterwards, I talked to the tech people there, and they were saying, actually, we're experiencing a 40% improvement. Now, I know this is one of these things you referred to earlier, that all these things get competed away because everybody else will be doing similar things. Can you just talk a little bit about how you perceive this whole area, and how do you handle it as an investor? I mean, how do you think about it? Because I was quite enthusiastic about, the WPP commentary, but it's quite difficult to understand what their competitors are doing today or what their competitors will be doing tomorrow, and the relative rate of change. How do you think about that?
Well, when we talk about AI, I think what you really mean is generative AI, because AI has been around a hell of a long time.
Yeah, no, sure.
And AI powers Amazon, and it's powered Meta, and it powers Google, and it powers banks, and it powers Revolut, giving you a fraud notice. I mean, AI has been around for a very long time, and that's going to continue. Generative AI is the latest sort of iteration of that. The biggest application of generative AI, or the nearest real-world large application of generative AI, it seems to me, is going to be in online advertising. When you think about how have SMEs advertised in the past? Well, they've bought stuff in local papers. Now they can go to Google, and now they can go to Meta. But actually, what does generative AI give them? Well, if you read Mark Zuckerberg's blogs on what Tesla's been doing, generative AI and ad copy, and the ability to create lots and lots of different versions of ad copy, the ability to make images from words, the ability to change backgrounds, then generative AI or AI and the ability to do A/B testing at scale instantly, AI and the ability to test audiences. These things are all phenomenal. And clearly it's going to come to many industries. And an obvious one will be business services.
Sure.
Because we all know we go online for business services. We don't like hanging on to a phone. And better chatbots which can really answer questions clearly, absolutely marvelous. It's going to be a very, very big thing. I guess it will definitely create losers as well as winners. And I happen to think that I happen to think Google and Meta are very attractive stocks.
You're not concerned that search loses out in this, because that seems a terrible risk. I mean, I know that DeepMind's very, very advanced in all this, and we don't really know the relative position of DeepMind and OpenAI and the other participants. But
there is a risk that search loses out. There is a risk that incrementally individual apps and chatbots cannibalize general search. But general search, Google does have massive distribution at scale. It's been investing in this for longer, and it has, and it's filed far more patents and papers about AI than anyone else. It's got immense compute. It's got, how often does Google's internet go down? Hardly ever. And we're quite habituated to search. And well, that's what I think will sustain it. But look, clearly it's less certain than it was.
Yeah. It hasn't been reflected in the share price, interestingly.
No, it hasn't. But clearly it's less certain than it was.
Yeah.
Google's position is less certain. It has to be.
It's been... I've
Look,
been
if you can go to
positive about it.
booking.com and say, find me a trip, make me a trip to Paris, and what shall I see? If booking.com can do that as well as Google, that's a risk to Google.
Yeah. It's interesting. There doesn't seem to be a lot of talk about it. And I have been puzzled as to why people haven't been more worried. Have you done anything on sort of applying AI internally within the firm? I mean, are you a believer in that?
I mean, no, we haven't yet.
And is that something that you think will be important to investors?
Well, I don't know whether it's important to investors. The question is whether it'll be important to us. And the answer is I don't know. The answer is I don't know.
Does it worry you? I mean, is it something that you...
Well, I'm in the happy stage where I'm not starting my career now. Clearly, all these things are going to make markets more efficient, and we'll all have to find a different way to get ahead.
I think...
And look, data scrapers make markets more efficient.
Yeah.
So maybe you've got to invest in things where short-term data is less important. Maybe you've got to have a longer-term perspective and be right about that. Maybe you've got to exploit drawdowns caused by people who sell things because the latest contemporaneous data is a negative.
But does that not mean that you need to have the data scientists and the infrastructure in order to understand that's why they're selling it? I mean,
I'd rather not invest in a company where I feel I've got to do a data science check every 2 minutes to work out whether it's doing well. I mean, I'd like to have data about terms and conditions on reinsurance contracts and how they've changed. Unfortunately, that's private. I'd like to have data about Amazon's cloud backlog, but I'm not going to get that from using data science. And there is stuff which is more important than what data science can give you.
I guess the thing is...
And I think it would be awfully difficult to follow a company like Tesla. And, there are these people who every month write about the number of planes Airbus or Boeing has produced in a month. And then they write about test flights. And that's all very interesting. But is the important thing how many planes Airbus produced in May when there were like 4 different holidays in Europe? Or is the important thing what they'll produce in 2027? Well, I think it's the latter.
Sure. But so what do you do with something like Ryanair, which is reporting monthly traffic figures and creating a lot of noise? Do you just not worry about it and just watch the share price?
Yes, I do worry about it. And we've been caught off guard by their weak pricing. I do worry about it. But I also think, you can't invest for monthly data.
No.
And so you have to find a way around that. And a way around that is thinking about whether something's a good business and what are its medium-term prospects, not what it's done last month. Ryanair is a slightly different sort of beast because its earnings are the result of its pricing changes in real time. So it's a sort of different kind of beast to other businesses in which you might invest where pricing and demand has sort of longer term cycles and changes gradually.
I just use the Ryanair example because it's an example of one where you could scrape the data every day or 100 times a day, or I don't know how often people do it, but you can scrape the data and come up with your own algorithm as to what is the yield. And I mean, it would be an awful lot of effort, and I'm not sure that it would give you a huge amount of reward. But I was just curious as to...
It probably is one where you could probably do that. Yeah.
No, I'm sure there are people doing it. I don't know if they, having been an airline analyst when I was on the sell side, and constantly being asked what was the next monthly traffic figure likely to be, and having no clue about it. And it was hard enough trying to work out what the quarterly earnings were going to be, and I found that pretty difficult. One thing I wanted to ask you about was private equity, and I don't know. Do you keep an eye on what's happening in private equity markets, or is it something that you feel resistant to?
I mean, I don't keep an eye on it. We sometimes we have invested in private equity firms. I mean, I think the thing to keep an eye on is monetization rates and the extent to which companies are going to make money out of the more recent vintage years.
And that looks troubling.
I don't know what it looks like. I mean, it'll be interesting to see.
Are you invested in KKR anymore? Or?
We don't own KKR. I wish we did. Or I wish we had.
Well, I'm not sure whether you will going forward. And were you surprised when we're meeting on Friday in June, when Revolut is supposed to be looking for a 40 billion valuation, which is probably, well, the European banks have done reasonably well this year, but it is pretty big for a bank. Have you been surprised by some of the valuations and VCs being, their aspirations continuing to be so high?
Well, look, the awful thing is I don't know a lot about VC investing, and I don't really know much about these valuations. But yeah, I mean, I think at times it is very surprising.
So one of the things that has puzzled me is you believe in having weekly valuations, and you're a pretty liquid fund. I mean, you've got different classes, obviously, but I was curious if you had ever thought about raising permanent capital and having an investment trust or a vehicle of that nature, which would allow you to take longer term.
I mean, I think the danger with longer term locked up money is that you sort of say to yourself, well, I'm underperforming, but guess what? I've got a longer term perspective. It's all fine. I can think on a 2-year basis because the money isn't going to go. And then you realize that you were underperforming for a reason, and that this long term capital had lulled you into a sense of into the wrong sense of security, into a false sense of security. I think that's the danger. And I mean, I happen to like liquidity. I think it's a good thing to be able to get your money out. And when I was at Morgan Grenfell, I ran a fund with daily liquidity. And I actually think that's quite a good discipline.
So you like the insecurity of the...
I don't like it, but I think it's healthy. And it's healthy for our investors.
And do you think it makes you a better investor?
I don't know.
But because I asked this because I was quite bemused by the Bill Ackman raising $1 billion at a $10 billion valuation for his business, which is sort of 65% of his present AUM, which is mainly the vehicle which is listed in London. And apparently he's going to raise 25.
Well, obviously it's based on the fund he's going to raise. But what I would say is it probably puts a lot of money on the people, probably values the investment decision makers in the business pretty highly.
He's 58, right?
Well, he's obviously worth $5 billion to the business.
At least.
Which is a lot.
It's so it was a huge amount of money, and I was just puzzled as to how one might manage 3 publicly listed companies. Presumably, if he lists the permanent capital vehicle in the United States, it's going to be very difficult for him to create 2 vehicles with exactly the same investment profile, which...
Well, the answer is I don't really know. I haven't studied it, but I would guess he's either going to have to make the same investments in much bigger size, or else have a lot of different investments.
It's I'm been scratching my head about it. It's quite really pretty difficult. Now, last time we spoke, you said your hobby was reading annual reports, and one of your colleagues,
which was slightly tongue in cheek.
Well, one of your colleagues told me that when you get on an airplane, you take a pile of 10Ks or annual reports and you manage to get through them very quickly.
Well, now I take an iPad.
So, but you get through them quite quickly.
I like reading things, yeah.
Do you have a process for doing it? I mean, how can you do it so efficiently?
Well, I don't know that I do it efficiently, but I think, you have to be aware of what you're looking out for, and you have to be able to sort out the wheat from the chaff.
And is this something that you find easier with companies that you've followed for a long time?
Well, I think it is easier of
Yeah.
course, yeah, because you know them better, so you know what to look out for.
So do you approach it differently if you're looking at a new company?
Well, it's more of a mountain to climb, getting to know something new.
What would your process be if you picked up a new stock? I mean, ordinarily your analyst will have given you
Well, I mean, it's the same as, it's fairly sort of standard. You want to read what the disclosures are. You want to find out what the management is saying. We like reading transcripts. We like reading filings. We make a model. We talk to the company. We talk to the sell side. And it's a sort of iterative process involving question and answers. And each time you learn something, a new question is raised in your mind.
And you said you had 35 positions. Would you have like a watch list of stuff that you're involved with beyond that? Or?
We do have a watch list. It's not very formal, and we're always trying to find new ideas. So we're always looking out for new ideas. Yeah.
And what are you interested in at the moment? You mentioned reinsurance. So I was at the Berkshire Hathaway meeting, and Ajit Jain was talking about climate change, and I hadn't really thought about this before. I tend to stay well away from the financials because having worked in a financials hedge fund, I realized how difficult and how much of a black box some of these things are. But he basically said, climate change is pretty good for our business because it makes boards much more
I
conscious
think
of the
boards,
risk.
this is an era where boards are more focused on risk.
Yeah.
So I think there is more awareness of that, and therefore I think there is more demand for insurance. And I think that at a boardroom level, reinsurers are aware that they've got to start making that they have to make returns. And I think that's what the 2023 reset was all about. And so I do think that's a good thing, because I think it's a cycle which will last for a bit. And I think it will take time for the earnings to come through.
Sure. But that's because
Because insurance is an unusual business where the results you report at the end of any year are really an estimate, because you only actually know what you've lost from a contract after a period of time, and it could be anything from 2 to 20 years if it's a casualty contract. So companies have to make an estimate. The nature of human beings is that when things are bad, they're too pessimistic, and and it takes them time to swing round. And if you come through a very bad period, I think you're going to be very cautious about recognizing that it's good. That's just a behavioral thing. And terms and conditions have radically reset in favor of reinsurers, which is positive. Look, this is a year where in the US, where there have been more severe convective storms than any time in the last 10 years. And we're in a storm season at the moment. And up till a couple of weeks ago, the damage from storms and sort of minor catastrophes is over the average, it's over the median of the last 10 years. And that means premiums have to go up. And more premiums equals good for insurers.
Well, it's a capital cycle kind of approach. Does that play a big part in your thinking? I mean, to what extent are you top-down driven?
Well, I think no one can be an investor without having some sort of top-down perspective. But ours is quite loose. Look, I don't think we're going to go back to a zero cost of capital world.
No.
That's as far as I would go. I think inflation, it'll probably take time for inflation to drop. And I think politics is something to be, geopolitics is something to be guarded about. But of course, geopolitics, if it's bad, will be unimportant for markets right up until the day it happens. Geopolitics is irrelevant until you get hit.
Does that mean you don't worry about it? No.
Yeah, I do worry about it, to my cost, because it's meant that we didn't invest in TSMC.
Are there any other sectors that you're sort of interested in now that you think are that the reinsurance is really interesting?
Well, I like some of the world's very cheap banks because I think there's been a big behavioural change in the banking sector, and they all have lots of capital and very conservatively struck loan portfolios and high provisioning, and they're going to return a lot of money. And I like aerospace a lot. That's engines and OEMs. And I really like a company called Flutter, which is the leading online gaming business in the States.
Why do you like
online sports betting? Because it's being liberalised and it's booming, and they have 55% of net gaming revenues in America. And online sports betting is, like many online things, an area where the winner takes all or most of it. And the more bettors you have, and the more compute power, the better you can assess the price and the odds. You can offer better prices, and if you work them out right, you can get a high win ratio, therefore attract more people, therefore find out more about them. And in today's world, if you're an online sports betting person on the Flutter platform, they can do an individual promotion to you. And they're also able to assess whether you or I, let's take it's a football team, are you or I good at betting on corners? Are we good at it individually? So they can price odds individually. So I think it's a very, 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 very well-run company.
Are you a betting man?
No.
That doesn't surprise me, Thomas. Your team, is it mainly analysts, or do people have PM responsibility as well?
Well, we're all kind of analysts. I think the only way is to analyze companies. We arrive at convictions on stocks through, several people cooperating, and I have to love something for it to be a big position.
How does the teamwork work? I mean, do you have people with different skills cooperating? I mean, one of my
I don't
podcasts...
say different skills, but different knowledge sets, different areas of focus. And I like people who know about different and contrasting. I like having people who know about different and contrasting sectors, so that they know there's a world outside their own speciality.
So people will have a specialism, but they will also look at something outside their specialism.
Yeah, multi-specialists, multi-sector specialism. That's what I like.
And why do you think that works? Because most firms
the danger is that you don't want to have someone who covers banks and will only think about the best bank in the world, because the best bank in the world might be less interesting than the best software company, and in the same way, and that goes the other way around.
But the problem with doing that, and I completely agree with you, but the problem with doing that is they can't spend all their time. The bank's a massive sector and really difficult, and could absorb a whole team's time. So they're unable to go as deep as they might otherwise do if they're looking at more than one area. Is that not a problem?
It depends how focused people are. Because, investment firms, they don't have to know about everything. They have to know about what's important.
Sure.
And so the question is finding out what's important and then focusing on that. But I like people who know that, it's, if the only space to be in is in enterprise software, it's great to know what the best enterprise software companies are. But if that's all you know about, and that isn't the right space, that's a bad thing. And if that's all you know about, and by the way, it's a lot to know about, and if that's what you know about, but a home builder is more attractive, it helps to have a broader perspective. And I think people with a broader perspective, as well as a sort of detailed focus, I think that's more valuable.
How about geographically? I mean, do people have a geographic bent?
Some
here?
people do more in America than others.
Do you try and have sort of somebody that knows about each country, or...
No, we don't, because I tend to feel sectors are more global. They're not always, but I tend to feel it's more global.
And how do you cope with something like what's happening in Japan right now? I mean, do you have a Japanese expert?
Well, I find Japan quite difficult because, first of all, there are a lot of secular changes going on in Japan, initiated by the Japanese Stock Exchange and by government authorities or government-related authorities, and by activism. That's a tremendous tick. At the same time, I wonder how the US stock market or the European stock market would have done if its currency had fallen by a third. And the answer is it would have done a lot better than it has. And there is part of me which wonders, is Japan a macro trade? So that's one thing which sort of holds me back. But the second thing which holds me back in Japan is, we've had meetings with Japanese companies, lots of them. And basically the meetings tend to be in Japanese through an interpreter. You have 1 hour. And let's face it, you don't know how your question was translated. You don't know what the company said. And in any case, half the meeting's wasted.
No, that is difficult. I mean, have you noticed any change in attitude though? Because
Well, there's clearly a change in attitude initiated by the JSE, but it's not universal.
I just wondered if you had a feeling whether the corporate sector's really embraced it or whether they've sort of
I
been
think
dragged.
I think a lot of it has, but some of it hasn't. Look, we own a food company in Japan which makes instant noodles in America. Big business in America, big business in Mexico, food business in Japan. They got a vast amount of net cash. It was proposed to them that they pay a special dividend. Their dividend payout is absurd. It was proposed to them they pay a special dividend and they stop investing in areas which underperform, and it met with a resounding thumbs down from the board.
John, you're normally very low profile, but you've been quite outspoken on two occasions, I think. One was the Brexit vote, and the other was talking about the attitudes after the tragic events in Israel on October 7th last year. Why were those two issues important to you?
Well, I never really spoke out over Brexit, but I think I did give some money to the Remain campaign, and I half feel that if we hadn't left, it would have left this massively divided society still divided. So societally, I don't know whether it would have been the wrong thing to have stayed or not, but I thought economically it was wrong. Look, on the Hamas thing, first of all, I feel that the only solution, and I'm not an expert, and what do I know, but I feel clearly the only solution in the Middle East is a two-state solution. Israel's never going to make that happen, and nor now is Hamas. Secondly, what sickened me was that there were these massacres. They were massacres. You can't get away from it. And not a single person who's talked about the war, not a single one of these protesters has ever, as far as I can tell, mentioned the massacres. I think it's completely despicable. Nor have any of these protesters ever protested when Islamic people are murdering each other, which they have done in Iran, which they have done in Syria. I have never noticed protesters then. And I really despise that. I think it's the most tremendous double standard. And I think in this country, we have a major issue with, and I have to be careful with my words here, with militant Islamism. And I say militant and extreme Islamism, and I wouldn't want the words to be separated, because clearly there are many different sorts of Islam, but for some reason, it seems to me, we in our country have a situation where there's no condemnation of massacres, and it's very easy for highly anti-democratic, highly unpleasant forces to take control of Muslim communities. I'm flabbergasted that it's not an election issue, that there is still a teacher in hiding. Well, I know why it's not an election issue, because the Conservatives would get accused of Islamophobia, and Labour's got 8 million Muslim voters.
Yeah.
So there's no way they can say it's a bad thing. But the fact is that there are 8 million Muslim people in our country, and there's 75 to 80% of all the threats MI5 investigates.
But it's a difficult problem to cure, right?
Yeah.
It's really difficult.
But it's not a problem we're addressing. I also sort of think, this war would have ended long ago if Hamas had done one thing, which none of these protest marchers tell them to do. And it's very simple. They could have just released the hostages.
No, absolutely. Yeah. Listen, I really appreciate you taking the time, and thank you for sharing your thoughts on that. I wanted to just finish on a sort of looking to the future note, and just to tap into your long experience and just some advice for young people. So what would you say to somebody who's thinking about what university degree to do or what career to pursue? So a young person who's sort of entering the workforce or thinking about entering the workforce. We've seen, just in the last 30 years, we've seen enormous change, and what seems quite likely is there'll be even faster change, if anything, over the next 30 years. How should people think about preparing themselves for that, and how should they think about choosing a career when lots of jobs are going to be very, very different? And how can you protect yourself?
Okay, well, I mean, look, the first thing to say about experience, yes. I mean, experience is useful, but it's not always useful. And sometimes experience, frankly, is a bad thing to have. And I sometimes think today I'd be a much better investor if I was younger and younger and naive. But, you know, what would I suggest? Well, look, I've been very lucky to have my career at probably the best time. I was talking about this to a friend, actually. And we sort of realized, we sort of thought 1865 would have been a comparably good period to have had a 30-year career or 40-year career relative to when I had it. That's what we thought.
But you've had to own the railways then.
Yes, but, you know, that was a great time to be an investor.
Yeah.
And I've had my career at a great time for the markets and to be an investor. I'm not sure it's going to be the same. I think today, look, where is the future? You know, what are the relevant skills today? They're clearly to do with technology. So I think everyone should be familiar with that. But I also think people should go to universities to be educated as well as to learn a trade. You're going to have the whole of your life to work. So I think, you know, people should go to universities to study human society and the nature of what it is to be human. And whether that's studying history or whether that's studying English literature or foreign literature or philosophy, I don't know. But we have to be educated at university. People who are not educated can be easily manipulated. We can see it today. Why was Germany manipulated in the 1930s? Because people used the myth of the civilian stab in the back. Why is our past being reinvented today to suit the convictions of the present? And I think it's very important that when people grow up, they should learn about the highly complex nature of human societies, of our past, and what it means and what it meant to be human. And a particular bee in my bonnet today is this tendency to judge human beings of the past by the standards of today. Yes, I mean, we laugh, but that's what happens. And I think people need to be educated in the past, and I think they need to be educated in society, and I think you get more of that through arts-related subjects than you do through subjects which teach you a trade.
I agree. And it's a great training to be an investor.
I think it's a good training to be an investor, yeah.
John Armitage, thank you very much.
It's been my pleasure.
Well, John's humility is astonishing. He must be one of the best investors in the world, yet he's never satisfied with his own performance. And perhaps it's that relentless focus which is the secret of his success. John has an ability to summarize concepts and to explain why he owns stocks, distilling it down to the absolute essence. My biggest takeaway was that this must be the most important skill to cultivate. Work out what's important and focus on that. I'm afraid it's easier said than done. As I said at the start, it really has been a privilege to sit down with brilliant people for this podcast and learn from them. Amazingly, this is my 40th show, and I'm grateful not only to my fantastic guests, but to you, the listeners. As ever, if you enjoyed the episode, those 5-star ratings really help spread the word. Thanks for your support. Thank you for listening. I'm Steve Clapham. That was the Behind the Balance Sheet podcast. Please don't forget to subscribe to the YouTube channel. And why not visit our website, behindthebalancesheet.com, where you can find the show notes and lots of other videos which can help you on your investing journey. Thank you for watching.